Welcome to Global Perspectives by Hilco Global. This is where we explore the forces that are shaping economies, markets, and industries. I'm your host, Patrick Murphy, and we're joined today by my Wharton colleague, Dr. Jessica Wachter. She is a phenomenal human being. She was the chief economist at the SEC. She is just leading a new program at Wharton in quantitative financing. She's a published author and just a great person and a senior advisor to us here at Hilco Global. Jessica, thanks so much for joining us today.
Well, Patrick, thank you so much for that very kind introduction. And I'm very excited, I should say, about being a senior advisor, and I'm excited about the program at Wharton. I will say that the program at Wharton is a team effort, so there's several of us who are deeply involved, and it is a brand new degree program, and we're taking applications from current juniors at the University of Pennsylvania. We're pretty excited about what we'll be able to do with this program.
Yeah, I'm going to one of the Wharton second-year MBA program. She was an Army officer. I'm going to her wedding. She's marrying another Army officer who's at Harvard right now. But, I get invigorated being around the students. But tell us about that new program on quantitative financing, if you don't mind.
Yeah, so it's a program on quantitative finance, and what we're going to do is accept people in their junior year, University of Pennsylvania students, either Wharton or non-Wharton students. Both are welcome to apply. That will determine, if they get in, that will determine what courses they take in their senior year, some of their courses, and then they will stay for an additional year and they will receive a master's degree. We're planning practicums for the students. There will be internships, and also my course will be uniquely offered in this master's program.
That's awesome. Well, listen, I know we're going to focus our conversation today a little bit on sovereign debt. I mean, you are literally a world expert on it. I'm passionate about it because I talk about someone who's on the appropriations committee, and then when I was helping run the Army, we had this program called Every Dollar Counts because, in the Army we had 1.3 million people and a $158 billion budget. But if we could talk real quick about the current landscape, right? So, and it's not just about the United States, but it's about most of the major world economies across the globe. When we talk about China, Japan, et cetera, but U.S. specifically, we're right now $37 trillion in debt. The U.S. dollar this year alone obviously went down 10%. We're about $1 trillion a year to pay off the interest on our national debt. But it's not just, an American problem. It's a world problem when we talk about sovereign debt. Can you elaborate?
So this is a passion for me too. So it's a joint passion coming from different perspectives. So I recently wrote a paper on it. We're wrapping up this paper. We started this paper in 2017. And so that was a different landscape. And we were, at that point, interested in the fact that interest rates on U.S. debt were so low. Since then, of course, we've seen much more elevated interest rates. But what we found is that we now have a framework to think about what is driving the interest rate and the role that sovereign default risk plays. And what we found in our framework is that sovereign default risk is back in a big way. That's really the simplest explanation for the rise in interest rates that we saw in 2022, and that's been sustained to this day. And that's very unfortunate, I would say, for all of us.
Yeah, I mean, even Bridgewater's Ray Dalio has a book out called How Countries Go Broke. And when we talk about the advanced economies, I mean, it's not just America that's over 100% debt to GDP ratio. It is Japan, China, most European countries, et cetera, Canada. Is this something that's new or something that ebbs and flows throughout the 21st century?
Well, I think we're unfortunately in a pretty dangerous period right now because we had a period where we had a good amount of credibility, and that credibility was built up over years. I'm afraid that we have lost some of that credibility. I say some because we could lose more. Yeah. So I think this is a period of concern of the like that we haven't seen since perhaps right after World War II.
Yeah. And then, when you look at this, it's like, it's always a balance. There's not one easy answer. It's chess, not checkers. But when you talk about valuation versus rates, how do you, as an economist and someone who is the lead economist for the SEC, how do you look at that puzzle between those two different elements?
So in terms of valuation and rates, we have a model, the paper that I wrote with several co-authors, Max Miller and James Perrone, we have a model, and that allows us to connect all of these dots. And the model is pretty simple, so you can see transparently where things are coming from. They come from the desire to save, from growth, from expected inflation, from default risk. So having a framework like that is pretty easy. Now, or makes things, I would say, simple, if not easy. At the Securities and Exchange Commission, it's, of course, a different kind of problem. There we're thinking about economic analysis of rules, and it's really setting the framework for how the markets should operate.
Yeah. And obviously we just lowered the rates as far as last quarter, for the first time in over a year or so. How about as far as inflation risk premium? Can you walk us through that?
Yeah, so the inflation risk premium, it's a pretty subtle concept because it's easy to confuse inflation risk premium with the compensation for inflation. So just one example, let's say you expect inflation to be 2.5%, so 250 basis points. That expectation is going to go directly into the nominal interest rate because people need compensation. If they expect they're going to lose that amount through inflation, they're just going to put that in. Now, separately, rates could be high because there's uncertainty about that inflation risk about that amount of inflation. And most likely the uncertainty goes up with the level of inflation. I think that's pretty reasonable to assume. Yeah. So then you get into a question of what is that high inflation going to look like? Is it going to occur at a time when other bad stuff is happening? And that premium can be pretty substantial. It can be of the same order of magnitude as the inflation risk itself. So it can be something close to 2 percentage points.
Yeah. We're going to talk later on about how this affects business operators and companies and corporations. I can't help but I want to talk about the historical context. Before I joined Wharton, I was a professor at West Point, so I love talking about history. I won't go back though, Jessica, on the Roman Empire and how they went broke under financial crisis, but I'll keep it to the 20th and 21st century. You already mentioned, back after World War II in 1946, right? American GDP over 100%. But in the next 3 decades, in 1974, our debt to GDP was about 26%. But in those 3 decades, the American dollar became the currency of the world, right? Why was that so important to our own economy and the world's economy?
So that's crucial. And I would argue that in a way we were able to expand the debt so much because we had this nice situation where not only did we have credibility, but there was also a convenience yield, and the dollar was the reserve currency. So we really do want to keep that. That is a relatively substantial part. So you could say that the convenience yield might be as high as 1 percentage point itself. You don't want to lose that convenience yield. But just to go back to what you're saying, we built that credibility up over years. So the debt came down after World War II. We ran surpluses. We paid off the debt. And I believe that people, that credibility built up, and investors said, to themselves, the U.S. will do the right thing. They will pay off the debt rather than inflate away the debt. That was the view in the 90s. And that was the view in the 2000s, built up over the 90s. Now I think that view has deteriorated, and that's going to cost people real money.
Yeah. I mean, I look at even those 3 decades that we just mentioned, we still made major investments. You look at Eisenhower, the only 2 presidents that actually balanced their budgets at the time was President Eisenhower and President Clinton. And Eisenhower, obviously, massive expansion on the interstate program, the massive infrastructure investments at the time. How about as far as though, beside America, right? Because we're looking at this as in a global perspective. The UK glit crisis back in 2022, we had Liz Truss, obviously, unfunded tax breaks, tax cuts, where really the Bank of England had to step in. Can you walk us through that crisis?
Right. So there was a shock, a surprise movement in expectations in terms of whether the UK would repay its debt. Mm-hmm. And that caused a pretty significant move in rates that looked like it was going to precipitate a crisis. Then as you mentioned, the Bank of England stepped in and they, in a way, somewhat artificially brought rates down. And I think this is a great example of what can happen when we're in this situation, because expectations can turn on a dime, interest rates can rise, and eventually it may be too much even for the Fed to handle.
Yeah. Let's walk through, if it's okay. Okay, Japan, post-1990s, the debt hangover, right? So they had a big debt big debt cycle. They had stagflation. Can you walk us through the lessons learned from Japan, again, late 1990s?
So Japan had a period of low growth, very low growth. People refer to it as the lost decade. And low growth just makes everything harder. So we don't want to see that here. Now, we have a very different situation than Japan, but there's no reason to suspect that couldn't happen.
Yeah. All right. And then how about the Eurozone debt crisis? We talk about 2010, 2015. How about we walk through that real quick?
So, that's a similar situation with some economies in the Eurozone really losing their credibility and rates going higher. And again, in the U.S., you could see rates go higher. They could potentially go very high. And what happens is potentially austerity measures. That's not really good for anybody. So we would like kind of a smooth transition to a more credible equilibrium.
Yeah, I think for the most amateurs out there that aren't in your position, like, oh, we'll just have austerity measures. Well, that really depresses demand. That really depresses. So that's why that's not the easy answer either. That's why we say it's checkers and not chess, because all these factors have to weigh in.
Yes, I agree.
Yeah. All right. So let's, if we can, the current sovereign debt crisis that we're in America and across the world with all these advanced economies, we argue in our paper at Hilco Global that it's really four factors. I know you've read it and we've talked about it, but let's just talk about the aging population. I look at, back in basically 1965, basically it was 10% of the population was 65 years and above. This is when we passed Social Security, Medicare. But now it's 18% of American population is over the age of, or 65 and over. But you're seeing it in other countries as well. That's a main factor, you would agree?
Well, I think it's one of them for sure. And if you look at where the U.S. budget goes, it really is to Social Security and Medicare. So I think that's pretty substantial.
Yeah. How about the other factors like the remilitarization of countries throughout the globe? I know in 2024, so just not even 2 years ago, we spent about $2.7 trillion, not we meaning America, but advanced economies spent $2.7 trillion on defense. That was a record, about a 9% increase on just the year before. Do you think that's adding potentially to some of the issues?
Yes, I think unfortunately, because it's not as if we've got a peace dividend that we can now stop spending on defense.
Yeah. I mean, and you look at the volatility, the geopolitical volatility, obviously, that we're seeing and how it's going to affect supply chains and economies, et cetera. How about the other factor, infrastructure needs? I mean, we think about, there's been 4 industrial revolutions just in America and across the globe. One of them I think we're in is the AI, and data, revolution right now. We're seeing some of the effects on it, but the real need to invest in the infrastructure when we talk about data centers, the energy use, AI, the factors there. How do you see some of those infrastructure needs that not just America, but the rest of the advanced economies need to invest in?
Yeah. So, I mean, infrastructure needs are real and they can promote growth in the long run. So it's a really tricky problem because right now we don't have that flexibility with the debt. We have to somehow find our way to bringing down the debt because, of course, you didn't mention the interest costs, but they're there. And if we don't have sustained credibility, then they might rise. Yeah,
listen, the interest cost in 2025, it's, again, $1 trillion in the federal government level, which is more than the defense budget, more than the VA. So it's definitely, and that's just in America, but the other countries as well. But the last factor we talked about why we have this sovereign debt issue is really populism, right? Populism where, 57% of the citizens in these advanced economies say, hey, we're on the wrong track. Our economy's in decline. And you kind of make sure you're balancing kind of populist rhetoric, populist policies versus the mature decisions that countries need to make.
Yeah, I mean, I have a tremendous amount of faith in the American public, and I think we have to find our way to a solution here. So, yes, populism is an issue, but I think investors are still believing that we can find our way there.
Yeah. It's interesting. Most of it, you look at cities like Chicago. I was with Rahm Emanuel the other night. We had dinner, and he's talking about the people when he's married. The citizens don't want free programs. They want, like, he had a scholarship program where if you have a 3.0 in high school, you can go to college for free at the community college, right? But he's like, but you had to earn a 3.0, like, and people supported it. But I do think the American people are willing to have that shared sacrifice as long as they realize it's for the good of the order, in a sense.
I think that's exactly right. I think that there's a temptation to give people things and then not explain that it's got to be paid for. I understand that temptation, but I think events will force us out of that.
Yeah. So we talked about the factors of the current sovereign debt, aging population, remilitarization, infrastructure needs, populism. Anything else that you'd add, or any other comments on the kind of the why? I mean, these are major factors.
Yeah, I think that pretty much covered it. I will add that to some extent we were a victim of our success. So the low rates, I think, allowed people to believe that we could really borrow a lot. And, here we are, and rates aren't low anymore.
Yeah. I mean, even when you think about the housing crisis, and not just housing stock, but I talk about young men, young Americans especially. For too many of them, the American dream has become somewhat of a nightmare because, when you look at 50 years ago, to buy a house, it was basically twice your annual salary. Now it's over 5 times your annual salary. The housing stock's an issue, the interest rates. But really, the interest rates are still so low historically. But people, because they're paying now 5-6%, they're like, well, wait, it's not the 2-3% it was just 10 years ago.
Yes, exactly.
Yeah. But historically, it was much higher. I mean, when you talk about the 70s, et cetera. Okay. All right. So can we talk about, like, future projections? When I look at, we argue this in our Helco Global paper about, let's look at the base model, the bull model, and the bear model. Let's talk about the base model. Like, if you're a sovereign nation, you're looking, okay, well, what are we going to do? What's the base model, look like projection wise?
Yeah, so I really like that framework. I think it's a good way to think about this. So the base model, which I think is probably the most likely scenario, is we continue on our current path, that we do have this technological innovation, and that allows us to keep rates stable but things are maybe not as good as they could be in the presence of this debt. So basically the debt crowds out investment and profitable opportunities. It limits the ability of the federal government to help when it's needed. So it limits the possibilities for counter-cyclical fiscal policy, which is what you want. And overall, it just acts as a drag on the economy and on prosperity in the long run. That unfortunately is the base case. So it's sort of, we muddle through somehow. And I will say that base case does already factor in the innovation that we're experiencing and growth from the innovation. So that's that's already in a sense priced in there.
Right. Yeah. And you look at AI. I mean, there's going to be some tweaks, just like it was during the Industrial Revolution. I mean, it just really there'll be some more efficiencies, but we'll see how there'll be some job losses too here and there. Depending.
Yes, that's true as well.
Yeah. All right, let's go worst case scenario. Let's talk about the bear market. The bear.
Right. The bear case.
Yeah.
So the bear case.
Because I want to end on a positive note.
Yeah. No, we'll get there. There's a bull case. Don't worry. There's a bull case coming. So the bear case is one where rates go up, potentially to the levels we saw in the 70s. So those were double-digit rates. And then we start to institute austerity. It's really hard to imagine that not happening, but there are alternatives. Some of them are not good, though. So we're kind of forced into an austerity situation that acts as a drag on demand, as you pointed out. And there's just less money to be spent on things in general. So there's also, potentially further loss of credibility and all the problems that come with unpredictable inflation. It's hard to plan for things. It is potentially harder to buy a house because the rates are now much higher than what you were expecting. And generally not a good thing. People perceive that costs are higher in the supermarket, much higher, and not necessarily matched by their wages.
Yeah.
We don't want to go back to the 70s. You can go back and read old economics textbooks. Inflation was viewed as the preeminent challenge, which was then conquered through a severe recession. And so we don't want to go back there. But that is, I would say, bear case A. There's also bear case B, which is considerably grimmer, which is we actually lose control of inflation. And my focus for many years has been on rare events. I'm not going to say that can't happen here. So that's where you have something like Hungary post-World War II, where, that's the version where you don't see credibility. And that's about expectations. It's a hard thing to control. There you get into a situation of people lose faith in the government itself. It becomes like, a set of failed institutions. So, really want to avoid that case.
Yeah. Yeah. All right, let's
now,
go.
to happier things.
Yes, let's go to happier.
So if we develop the political economy that we can pay down the debt, I think that there's definitely that credibility out there that we could regain. And that would entail, there's a couple ways that could happen. Certainly one of them is growth that's even higher than projected. And so one view that people sometimes talk about is, the future, we're going to be so wealthy, we'll be able to do anything. Love if that were true. What I think has been historically the case is that our spending has grown along with economic growth. If we manage to keep spending down, or if growth is so high that makes it easier to keep spending down, then a couple things will happen. First of all, it will be easier to run. Surpluses will arise if we keep the debt down, if we keep spending down is what I mean. And also the debt will just grow smaller as a problem. So in that case, we then go back to the case where we pick up, or I should say rather lose a few percentage points on the interest we have to pay. And at that, then you can actually sustain the levels of debt that we had, in the 80s and so forth. And we, again, have the government that can step in, that can invest in the infrastructure we need, that can be a counter-cyclical force. That's the bull case. That's, what we're hoping for. It's physically possible. Whether it's possible with our political economy is another question.
Yeah. I think there's a lot of folks that look at it like, if there's a divided government, sometimes it's the most efficient way. Okay. Well, let's hope for a bull case here. Let's now talk about how these implications, how it affects business operators, right? How they need to really manage and have that perspective with sovereign debt across the globe when supply chains are not just domestic anymore, they're international.
Yeah, absolutely. So I wish we could take comfort in sovereign debt being a problem elsewhere. I think we absolutely cannot, because I believe, as we've seen, problems elsewhere will become problems here. I think that's unavoidable. So it's not a zero-sum game. We're all, on this blue marble together.
Right. No, and listen, we talked in the opening. I mean, this is sovereign debt is really, we're talking Japan, South Korea, China, Australia, New Zealand, most European countries, America, Canada. So we're all in this together in a sense in this global economy. How do business operators, though, maintain flexibility, or corporate entities maintain that flexibility they need to have during these times?
Yeah. So a couple points. And first, a kind of basic point, but it's always worth remembering, that the relevant number for CFOs is the company's cost of capital. And so I think one implication of sovereign debt and inflation being an issue is that you might see interest rates elevated. That doesn't necessarily mean a cost of capital is elevated. So that's not to say that there won't be spillovers, just to say that when looking at an interest rate, that may actually be high. Just because interest rates have gone up doesn't mean cost of capital have gone up, is the point. This could still be a really good environment for investing for a company. So I really think it's important for CFOs to keep that in mind. Now, that being said, historically, we have seen that risk on the geopolitical side, if it comes down, that allows for more risk-taking on the corporate sector and vice versa. We also see, to some extent, that debt on the geopolitical side crowds out debt in the corporate sector. So I think that having that extra flexibility is probably good. And so that would probably mean a little bit less of short-term borrowing because that needs to be rolled over. And if we're in an uncertain environment, then one doesn't want to find oneself in the situation that we saw in 2008, for example, where there was a commercial paper crisis. So generally, having that flexibility is something that could pay off.
Yeah, I was on the board of a major defense company, and because we were in the growth phase, and having that flexibility in your balance sheet that you have that liquidity to make acquisitions, you have that liquidity that when you talk about the cost of capital to make maneuvers and to do what you need to do to grow it.
Yeah.
And it's interesting because even with Hilco Global, we as you know, we were just acquired by Oryx USA. So our cost of capital, because we're merchant bank as well as financial services, is now going even lower than it was before, right? And that's how we're able to partner, in the private sector with folks that really want to have that growth strategy and move the ball forward. How about as far as stress testing? When you talk about these, geopolitical factors, when we talk about sovereign debt, how could corporations best stress test against these, macroeconomic, developments that are happening across the globe?
Well, so I think thinking of a range of scenarios is really important. So what we know from one of the lessons learned from 2008 is that people did not consider a wide enough range of scenarios. So I think looking historically, over the last 200 years and looking at a range of countries is really important here. So I would encourage people to do that. I think that's going to put CFOs and executives in the best possible situation.
Yeah, right. And doing a due diligence when you're talking about, your supply chain, when it comes from a certain entity,
That's right.
what might happen there.
Yeah.
Okay. All right. I always love asking people their favorite part. And so what is your favorite part about teaching at Wharton? I know we started there and we'd love to end there if that's okay.
So I love teaching at Wharton. I love the questions that the students ask me when I teach. I would say that is my favorite part, just hearing those questions every year and keeping it on my toes and reminding me what I found most interesting when I was starting off.
Yeah. And how about as far as what piece of advice would you give to business leaders, business operators out there that are trying to navigate the geopolitical tensions that we see across the globe?
Well, geopolitical tensions are one thing, but I would come back to the point about the cost of capital. And even though it's a risky environment, sometimes it's necessary to take a little bit of risk. And so I would not necessarily be deterred by all of this that's going on from, taking the risks that are necessary to keep one's business going.
Yeah. Well, Professor Wachter, thank you so much for joining us on Global Perspectives, by Hilco Global. We appreciate your leadership. We appreciate you being part of our team. And we appreciate you having this conversation with us here today and really providing the expertise that you continue to have across the globe. Thanks so much.
It's been a real pleasure. Thank you so much.
All righty.